Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Tuesday. It is September 28th. October is right around the corner, and it looks like volatility just cannot wait for October. For those of you who do not know, October is actually the most volatile month of the year, but it looks like we're getting ready for October earlier. Look at this. The Nasdaq is down 200 points. One of the biggest reasons, and if you look at the S&P, it's down only 30, and the Dow's down only about 100, which isn't all that much. But the Nasdaq being down 200 points is significant, and that's one of the biggest factors because the bond market is lower. We're breaking lower. Remember what I said? We're either going to go back up here or we're going to break down. Now remember, if we go lower on bonds, that means interest rates go higher. Interest rates, and tech stocks, they don't do well together. Because interest rates are fixed asset. It's fixed income. Tech stocks is highest yield, but risky volatility. So on one hand, you have low income. On one hand, you have high income. Here you have no volatility. Here you have a lot of volatility. And it's about what gets the best risk-adjusted returns. It's a waiting game. So I think one of the biggest reasons why we're seeing the bond market in the dumps, or it could be the reason we're seeing the Nasdaq down so much, is because of the bond market. I don't know which was first, which was second. We'll get into that when we talk about global economy in a minute. As far as data for the week, we had the durable good orders. The numbers were solid, but I'll be very straight with you. Everything is being shadowed by China and the GDP. And one of the biggest indicators is consumer confidence, which is coming out today at 10 o'clock. If consumer confidence is solid, it can really do a number on this market, because remember, consumers make up 2/3 of the economy, and GDP will tell us how the economy grew. Now, if the GDP does not reflect growth, there's a good chance that the Fed, the interest rates, the bond market will come back higher, because if the GDP, I'm sorry I'm going back and forth, but I want to make sure you have the full picture. So if the GDP is weak, if consumer confidence is weak, there's a good chance the Fed will say, well, we can't take any action. And if they don't take any action, that means they're not going to slow down buying bonds. And if they're not going to slow down buying bonds, bonds will go back up here where interest rates will go lower. Remember, bonds and interest rates have an inverse relationship. Lower interest rate, higher bonds. Higher bonds, lower interest rates. Higher interest rates are bad for tech stocks. So the fact that we are down substantially on the bond market is a good indication that we are right now cooling off. And if we stay here, and if the economic data is really solid, if the GDP is really solid, if the consumer confidence is really solid, we may see a further breakdown in the bond market, because the Fed may say, okay, time out. We're going to slow down the bond buying. That's where we're up against right now. So all these reports are great, but everything is leading into the GDP. So consumer confidence, global economy, everything is leading into this report right here. That's the biggest report of the quarter. And if we want to take a look at what the expectations are, just to give you an idea, we're looking at a consensus of about 6.7% growth quarter over quarter. That's what we're looking at, somewhere right around 6.7%. So if, let's say, we're 5%, well, not fast enough. We may have to slow this down. This will go up. But let's say this number is like 8. I'm just making this up for illustrative purposes only. Then what is the Fed going to say? We're growing. We need to slow down bond purchases because, I mean, we're going to keep doing it because, no, they're going to slow down. And if they do, bond market will drop. So keep your eye on the bond market. That's what's driving stocks, especially tech stocks, right now. Now, let's talk about global economy and talk about what's at stake there. A power crunch. I mean, China's just getting it from everybody. China does not need this right now. A power crunch in some parts of China has shut down factories and left households without electricity under effort to meet official energy use targets. I mean, really? Really? That could have global repercussions, including supplies needed for manufacturing. Remember, folks, most of the goodies that we get here in the U.S., like tech, all that stuff, it's made in China. And clothing, too, right ahead of the year-end shopping season. We do not need this right now. I mean, I'm already talking about markets gearing up for a year. I did a report yesterday about end-of-year shopping and how we're going to have a fragmented market and how we have to start looking at things now. And just today, like 12 hours later, I see this. So more supply chain issues. Now the ports, China, I mean, they're just COVID, energy. That's on top of parts of raw material shortages already manufacturing because of supply disruptions due to the COVID pandemic, which is what I just said earlier. So we got friction with China. We've got energy shortages in China. We've got Chinese government trying to reinvent global economy. And we've got COVID supply chain shortages. I mean, it's going to be a very interesting winter. I'm going to tell you that right now. Analysts say the power shortage in China could become prolonged as demand for coal and natural gas surge during the winter. Wow, that's big. The vote for the leader of Japan's ruling party set for Wednesday was also waiting on Tokyo trading. Now we're talking about Japan, but we're still in Asia. We still haven't come across the ocean. According to analysts, as players took a wait-and-see attitude, 4 candidates are in the race to replace Mr. Suga, who's stepping down after a year in the office. Consumer spending has been the key driver for the economic recovery, as has been crimped in parts by rising cases of COVID because of the highly contagious Delta variant, which remains a huge concern in Asia. And now, all the Chinese companies that moved to Vietnam so they could produce stuff without all the regulations that Trump tried to put on China back in his presidency, now Vietnam is getting screwed because their inoculation rate is like 6%. So it's kind of like China's just hurting everywhere. And we rely on China for our supply chain, big supply chain. So that is another major issue and why the markets are cooling off this much. Now, if we look at the put to call ratio, we're stable. We're back in the non-event zone. If you look at the VIX, it's also non-eventful. We're at the threshold 20 level, which means there could be something happening. Now, here's where it gets interesting. If you look at the Dow Jones, we are in twilight zone right now. Twilight zone is my word for saying between the 200-day moving average and the 50-day moving average. And it looks like we can go lower. Now, if we're going to remain in the twilight zone, the market's going to be very choppy without a lot of directional bias, which confirms my momentum analysis where I tell you guys that only 53% of stocks are trading above the 50-day moving average and also the 200-day moving average. So the market's not nearly as bullish as you would think it is by looking at charts. Even the Nasdaq, take a look at the Nasdaq. I think we're violating the 50-day moving average. Yeah, we're already below the 50-day moving average. So it looks like we're going to have a double bottom. And it's one of the reasons why stocks haven't really been going up. I think we're going to bottom out here. If bond market begins to recover, if consumer numbers are not as good, it's almost better, honestly, folks, it's almost better for the stock market, for consumer confidence, and for GDP to be on the lower end of the scale, because then the Fed will have a good excuse to keep pumping money into the market. I'm just being honest with you, because otherwise we could see this choppiness where stocks just don't go anywhere, where they're just humming like this, which is why when you're looking at momentum levels, you're seeing only 53% of all stocks trading above $2 above the 50-day line. And look at that, 53%, 53%, 52%. This market is very choppy right now, very choppy. It's not necessarily bearish, it's just choppy. The good thing about these momentum levels, especially if you look at this, they've come off quite a bit. So it's not like we're in a position where we're just going to drop. I mean, we're not up here. If we were up here, I would be very scared. We're at the 50-day line right now. Finally, the charts and the internals are finally coinciding. So it looks like we can either go up or down from here, but we're not really overbought anymore. So I just wanted to give you that. Now, in light of everything we're seeing right now, in light of volatility, in light of the choppy market, I think it's in your best interest to trade low-hanging fruits. And I've got 3 shorts. Yesterday I gave you 3 shorts, and today I'm giving you 3 shorts. Not necessarily because I'm expecting the market to go down. It's just easier right now for the market, for this choppiness, to trade to the short side because markets drop 3 times faster than they go up. So there's a good chance as it drops over the next few days, these 3 shorts will make some money. And let me give them to you. First one, 𝗧𝗶𝗺𝗧 Pharmaceutical. And all I'm thinking is here, look at this downtrend. If the Dow sells off a little bit, we're going to go down to the 126 level. So I would sell right here, 133, and I would cover my short. I would get out right here at the 139 level, and I would profit target right around at 127 level. CME Group, interestingly, how this was a darling last year, but we haven't been trading as much, right? Markets have not been as hot. So lower highs, trading below the 200-day and the 50-day. The 50-day is just crossing the 200-day. We're right at that risk level where if we go up a little bit above, it won't be as good of a trade. But I think this sucker will go down all the way from 197 all the way to 185. So if the market cools off a little bit, or if you have a long portfolio and you want to protect yourself, this is a good time because we're in that choppy market. As I showed you, only 50% of stocks, give or take, are trading above the 50-day line. So we're not really directional right now. So I would sell this all the way down to the 184 level. And last, 𝗧𝗴𝗀𝗀. Look at this. Market pulled up almost nothing, which means if the market cools off today, it'll probably sell off a little bit. So again, I'm only looking for this stock to go from the 146 to the 136 level down to here. And if it breaks the 151, you get out. So again, CME, sell below 197, cover your short at 185. 𝗧𝗴𝗀𝗀, sell at 146, cover your short at 137. And Jazz, sell at 133 and cover at 126. Now, folks, before you go, I've got something really, really important and timely, and something that I really think can help you out. Now, most people have never heard about this. That's why I'm talking about this. But every Friday, just before the market closes for the weekend, about an hour before the close, Wall Street wires millions of dollars into specific stocks. Most of the time, it's just because big news release, company mergers, drug approvals, earnings, something that could send a stock soaring. It's a catalyst that happens Friday afternoon. And anyone who can spot the specific activity could place a simple trade on Friday and then have a chance to wake up Monday morning to some of the biggest weekend profits. Who does not like weekend profits? Make money over the weekend while you rest and the market works in your favor. No day trading, in on Monday, in on Friday, out on Monday. Friday in, out on Monday. I love it. I love this. Anyone who spots this specific activity could place a simple trade on Friday and have a chance to wake up Monday morning with some of the biggest weekend profits. And let me tell you, there's nothing as sweet as weekend profits. Do you guys want to find out how you can spot trades like this? Of course you do. I want to see how you could spot trades like this. Click on the link below and check it out right now. Get all the details. This is really, really cool. Very, very, very cool. And folks, make sure to like this video. Subscribe to this channel if you're watching on YouTube. I want to get your feedback. Stay ahead of the market. Be the first to be notified when I post my next hot video for you. Bye.